All right, looks like we are live again on the live stream show. Another day and another attempted paper price smash on paper gold and silver prices without penalty, because the large Wall Street banks have already settled this case. They've paid their billion-dollar fines on their potentially over $100 billion in manipulation profits, because they make more money manipulating markets, rigging markets, and betting in the casino than actually lending into the real economy, tens of billions of dollars more. So then we have this Reuters article here about deterrence. For those of you who are new, that you can see on your screen, for those of you that are new, relatively new or new, Johnny-come-latelys to the gold and silver market, there is dip buying now. However, I want to talk about a research paper for those of us who have been in the gold and silver markets and I'm using air quotes here, markets, for a long time. Larry Summers, Mr. Lolita Express, Mr. Jeffrey Epstein, Mr. President of Harvard, wasn't he Assistant Treasury Secretary under Bob Rubin under the Clinton administration, Mr. Everyone Kisses His Ass, saying how smart he is, actually wrote a research paper about 25 years ago. The Gold Antitrust Action Committee has it on their website. You can look up Larry Summers, Gibson's paradox, talking about the correlation that used to be there between interest rates going down and gold prices going up, also balance sheet expansion of the central banks. And that's why central banks and their agents have to manipulate paper precious metal prices to destroy the correlation. I have an article behind the paywall for my patrons, for my over 1,000 still paying customers for only $5 a month from last week, talking about the correlation, how it broke down between the Fed's balance sheet. Initially, there was a strong correlation between Fed balance sheet growth and gold prices going up. And then for about 7 years, really in 2011, from about 8 years actually, from about 2011, 2012 to that period, I think somewhere in 2019, early to mid 2019, there was no correlation, meaning the Fed balance sheet was growing still, and the paper gold price and paper silver prices were getting absolutely smashed. And the people were laughing at that, saying, gold and silver, you're a moron. But it was clear in the charts there, the correlation was intentionally broken. So Gibson's paradox, that Larry Summers wrote an article outlaying that the government has to manipulate the gold and silver price to destroy the correlation between interest rates going down, gold prices going up, and balance sheet expansion from the central banks. However, the correlation between balance sheet expansion of the central banks, especially the Fed, and the gold price has started to be strongly correlated again starting in mid-2019. So as soon as the Fed balance sheet, around the time of Repo Madness, when Repo Madness started and the Fed balance, and remember in October 2019, we had Repo Madness, September 2019, and then not QE, where the Fed's official balance sheet, which they said was only temporary, was only going to temporarily increase. Yeah, sure. Yeah, here we are over a year later, and the balance sheet's still larger. They told us it was only temporary though, and the gold price started to react back then. So they're going to attempt to break this correlation, but more people are buying the dips. More people are buying physical gold and silver. More people are hedging out of the system, and more people are buying the best gold and silver stocks. Not those shitty juniors that you send me emails and comments and stuff like that. I would not buy those first, in my opinion. There's a lot of people who want to gamble. Oh, Eric Sprott bought this one, therefore I'm going to buy only that one junior because Eric Sprott bought it. That's not a good investment strategy. You're a gambler. You'd have more fun probably going to a casino. Okay, so despite JP Morgan's record spoofing fine, deterrence questions remain. And then I have there on your screen, what deterrence? They paid a fine. They're still right back to doing it. You can see it in the effing charts. You can see the high frequency trading algorithm, paper price smashes. I'm here on Kitco, and I know a lot of people in the gold community don't like Kitco, but I have the 24-hour spot gold, the charts up, and you could just see crazy smash downs in the charts at weird hours. So you can see it. It's right in the charts that something just comes in and just hammers the paper price, and then it starts recovering later. But there's attempted smashes still. There's still spoofing and all this stuff going on. Again, I don't think anyone's going to go to prison anymore because they paid their fine. So now the regulators, and I'm using air quotes, the regulators are going to move on. Anyway, let me just read this article to read. I have a couple other gold and silver related market questions for the short show. To read more by the Thompson, okay, JP Morgan's $920 million fine by U.S. regulators for, quote, spoofing which is fake bids and asks. They pull away bids. So they fake bids, which is illegal because they're faking bids. They're fooling people. Spoofing in the precious metals and U.S. Treasury markets, the practice of giving a false impression of market demand by rapidly entering and canceling orders. So if you are new to gold and silver, go look up Gibson's Paradox, Larry Summers. You can either find it on the Gold Antitrust Action Committee website, or you can find it elsewhere. My friend Dave Kranzler, Gold Fund Manager, has written about it many times, that there was a long correlation between lower interest rates and higher gold prices, and that's part of the paper price manipulation scheme that has been going on for over 20 years. Precious metals, U.S. Treasury markets, the practice of giving a false impression of market demand by rapidly entering and canceling orders. It's just amazing what the banks get away with. It's truly amazing. Would appear to be a sharp warning to the industry over the illegal practice, but whether the enormous penalty, which held no one criminally accountable, deters future misbehavior by large institution is questionable at best, say legal experts. Questionable at best, it's not going to deter at all. It's a cost of doing business. It's a tiny little fine, maybe 10, not even 10% probably, of the profits from manipulating and rigging these markets. This article is by Henry Egler. The full article will be below the video in the information and description section, Tuesday, October 13th from Reuters, if you want to read the rest of it. While the size of the fine reflects evident dissatisfaction with JP Morgan, the fine was technically a record. It was around $1 billion. They're saying $920 million, but it's relative to the profits, as I've been talking about for months. So the profits, and I haven't seen any credible study where anyone's tried to go back and guess at how many tens of billions or hundreds of billions of dollars have been made manipulating paper precious metal markets, the derivatives attached to them, all these different things. The mining shares that were shorted for many years, which has a long record of misdeeds in the industry. The settlement also seeks to demonstrate that spoofing is now considered as serious as rate rigging, corruption, or money laundering scandals. But no senior banksters go to prison. This should be added. Quote, there aren't many cases in the white-collar world that would warrant total penalties in these amounts, said James McDonald, enforcement director at U.S. regulator of the Commodities Futures Trading Commission. But no senior banksters are going to prison, which together with the Department of Justice led the prosecution of the bank's activities. The size of the fine, quote, reflects the scope and breadth of the conduct that's at issue, he said. And he's probably also getting steak dinners at some of the top steakhouses here in Washington, D.C. here, immediately after giving this short little interview there from the bank lobbyist. Or maybe it's one of those secret little parties in D.C. with the sugar babies. What the penalty puts into focus yet again is whether corporate malfeasance in financial services can be curbed solely by fines. The issue, answer, it can't be curbed solely by fines. The fines are a joke. The senior banksters don't even pay the fines out of their own pockets. They pay with shareholder capital. They're laughing. They get to collect their stock options and their bonuses, and their earnings per share targets are met. Their earnings per share targets are met with gambling on derivatives and leveraged currency and bond trades, which are more profitable than loaning into the real economy. And then also market rigging. Rigging and manipulating with high-frequency trading algorithms and seeing how much margin the average little trader has. How much margin are you using on your trading account? The banks can see that. They know. If you're trading commodities futures contracts, the banks know. The large banks know how much margin you're using. You're at a big disadvantage. Let's just put it that way. What the penalty puts into focus yet again is whether corporate malfeasance in financial services can be curbed solely by fines. Answer, it can't. The issue of monetary penalties versus jail time for senior executives has been debated endlessly since the 2008 financial crisis. Some legal experts believe a strong message has been sent. William Black has talked about how I don't like a lot of the stuff William Black says because I think he's like pretty anti-capitalist, but the senior banksters need to go to prison. There's tons of laws already on the books. Tons and tons and tons of fraud laws. Hundreds of fraud laws that have been violated. RICO laws, anti-money laundering, all these different types of fraud laws. And no one's getting charged with felonies and going to prison. It's all fines. And the bankers don't even pay their own fines. That's how dystopian things are. Some legal experts believe a strong message has been sent that other firms should be dissuaded from engaging in future misconduct. Yeah, they're the only ones who believe that. Quote, while we don't see traders lining up to go to jail for this offense, the efforts by the Commodities Futures Trading Commission, which at one point was run by a former managing director at Goldman Sachs and former campaign manager for Hillary Clinton's 2016 election campaign, Gary Gensler. Oh, also, I think he got to peer into Long-Term Capital Management's books and do some trading off that, according to Jim Rickards. So... and he was running the Commodities Futures Trading Commission. He was the main commissioner, and he was in charge of the gold and silver manipulation investigation. Commodities Futures for many years. Commodities Futures Trading Commission and the Department of Justice to prosecute clearly indicate that there is a threat of jail time. Said there's really no threat of jail time for the senior banksters. It's maybe a couple mid-level managers. They'll throw us a bone. They'll say a press release. They'll say, there, we got someone. We actually caught them. See, we're doing a good job. See, we're worth all 80,000 or 120,000 or 150,000 plus all the other perks of being a government employee. Said Eugene Soltes, professor at Harvard's Business School and an expert on white-collar crime. Quote, spoofing has just been an especially challenging area to secure individual-level convictions. A record corporate-level fine does help recognize that this conduct is wrong. Criminal, in fact, Soltes said. This is all bullshit. Soltes said, quote, for crimes like spoofing, compliance within banks really is the first line of defense. The sanction, it's compliance in the banks, yeah. Yeah, sure. The sanctions will help prevent this conduct from reoccurring, which that's their whole business model. They make billions, tens of billions of dollars a year manipulating markets, rigging markets in all different type of ways, and in taking the reserves that the Fed replenishes them with the magic money tree reserves, using that as collateral and going back to the casino to gamble. Oh, and then the deflationistas who don't understand any of this say that it's not inflationary, that there is no asset price inflation. They claim there is no inflation, that there has been no asset price inflation for the last 20 or 30 years. It's hilarious because I've actually had conversations with former managing directors at large banks like Goldman Sachs and Bear Stearns, and they just laugh at a lot of these deflationistas. These sanctions will help prevent this conduct from reoccurring, which ultimately is one of the most important objectives of white-collar sanctions. Other experts were less convinced, citing a long record of violations by JP Morgan. And if you don't believe me, Lloyd Blankfein, former CEO of Goldman Sachs, chairman of Goldman Sachs, he just did an interview in the last week for CNBC. The free 30-minute interview or so is on the Wall Street for Main Street Facebook group. The link's in the Wall Street for Main Street Facebook group. Maybe I'll do another show on it. And Lloyd Blankfein is talking about the asset bubbles, the asset price inflation, what 0% interest rates means to like the Cantillon effect. And then Lloyd Blankfein is talking about the ridiculousness of these special purpose asset companies, SPAC management. Lloyd Blankfein said about SPACs, that some of these people are raising money. They don't even have a business model. He said some of these SPAC managers, these hedge fund guys, or Paul Ryan or others, are raising $100 million or more. What's his name? Bill Ackman, I think, raised $3 or $4 billion. And they raised this money, and they don't even have a business model to invest the money. They just got the money. That's how crazy everything is. That is the Cantillon effect. All this currency and credit created out of thin air, sloshing around, creating asset price inflation. But there is no inflation, according to the deflationistas. Meanwhile, my healthcare bills are up enormously. My healthcare insurance premiums are up enormously the last 10 or 20 years. And my food bill, I'm just getting killed with shrinkflation for a long time now. Other experts were less convinced, citing a long record of violations by JP Morgan over the past 10 years, along with repeated deferred prosecution agreements and the lack of individual accountability at the highest levels of the organization. Exactly. Finally, someone's criticizing them. JP Morgan, we have tons of laws for fraud on the books. Tons. There's lots. They're just not being enforced. They're selectively enforced. So if you're the little guy or you're a tiny little trader, maybe you're going to get busted. They're going to throw the book at you because you can't afford lawyers. But the large senior banksters, no, none of them are going to prison. JP Morgan said those involved in the spoofing were no longer with the firm. Yeah, they got rid of like a handful of guys. And you could see it in the charts. There is still spoofing. Monday through Friday, It's like clockwork. But the dips are being bought, and later, after the smashes, the prices are recovering. So that's why, with the spoofing and the paper price smashes, that's why gold prices aren't back down to 1800 or below 1800, because there is very strong accumulation. There is very strong dip buying. That's why the paper price manipulation and the spoofing is not as effective. JP Morgan said those involved in the spoofing were no longer with the firm, and it said the Justice Department recognized that the bank had invested, quote, considerable resources in boosting. Yeah, I don't believe them. Considerable resources in boosting. This is like from The Office there. It's like where Steve Carell is trying to say something serious and everyone's just laughing at him. In boosting its internal compliance policy, surveillance systems, and training programs. JP Morgan's growing, quote, rap sheet. America's largest leading institution is no stranger to financial wrongdoing and enforcement actions which have led the bank to pay enormous sums to U.S. authorities. According to Good Jobs First, a resource organization that tracks corporate misdeeds, JP Morgan Chase has paid over $34 billion in fines since 2010 for a wide range of violations, with the largest $30 billion related to financial offenses. So if they're paying $34 billion in fines, what are their actual profits? I haven't tallied up the actual profits, but I imagine they've made hundreds of billions of dollars in profits over that span, because the fines are only, the way the people running the banks look at things is the fines are going to be a fraction. They're going to calculate out the cost-benefit analysis of paying a fine when they do manipulations or other market rigging or other shenanigans, maybe money laundering for drug dealers or drug cartels or terrorist organizations or organized crime syndicates, sex traffickers, Clinton Foundation, who knows? Jeffrey Epstein, who knows? $34 billion in fines since 2010 for a wide range of violations, with the largest $30 billion related to financial offenses. A total of 81 case incident records for financial offenses have occurred over the last 10 years, not including the latest settlement for spoofing crimes. The bank has also suffered an additional 67 incident records related to competition, consumer protection, government contracting, and employee-related offenses. Better Markets and Industry Watchdog recently published its own analysis on JP Morgan's wrongdoing, which covers a 20-year period until 2019. JP Morgan has a 20-year-long rap sheet. Actually, it's longer than that. That includes at least 80 major legal actions that have resulted in over $39 billion in fines and settlements. The report said, quote, any other business in America with that recidivist record would almost certainly have been shut down by prosecutors long ago. Here's the problem. The U.S. federal government and U.S. Treasury needs those banks. It's an incestuous relationship. It's a virtuous circle of crime. They need the large banks to buy those U.S. Treasuries. They are one of the major buyers. Besides the Federal Reserve, the banks are right behind the Federal Reserve for buying those Treasuries. It should have been shut down long ago by prosecutors. It said the largest banks are effectively shielded against executive prosecution and jail time. Exactly. Well, not prosecution. The senior bankers are. They'll throw a couple to the wolves. They'll throw a couple mid-level or low-level traders. Those guys are not safe. The guys at the top are safe. Among the largest U.S. financial institutions, only Bank of America has generated more fines and penalties over the past 10 years, probably because they bought Countrywide, which was super predatory, and committing lots of felonies and fraud, and no-doc loan fraud and ninja fraud and a bunch of other stuff during the 2008 from 2006 to 2008, because Bank of America bought Countrywide. And Angelo Mazzillo probably should have been in prison, almost definitely. According to the violation tracker application from Good Jobs First, with 213 financial offenses leading to $80 billion in fines. Okay, the rest of the article, there is quite a bit more here. I won't read that. The link to the article will be below the video in the information description section. The other gold and silver story I wanted to talk about was from October 16th from coinnews.net that you can see there on your screen. U.S. Mint increases prices on silver coins, silver sets, and silver medals. The United States Mint raised prices Tuesday, October 13th on its suite of numismatic, or actually I've seen articles saying it's semi-numismatic, silver products. Products affected include American Silver Eagles, silver-proof sets, 5-ounce silver coins, and silver medals. Several of the products have now seen more than one increase this year when compared against what they would have cost in 2019. Those released last year also now higher. Total price increases range from $9.50 to $75.05. So that is a lot more, those price increases, than how much silver spot prices have gone up. When, remember, not too long ago, I think it was February, March, silver prices were barely able to hold $15. And now here we are, let's pull it up. Silver prices are at, they're still above $24. They've gotten a little smashed a little bit down below 25. $24.47. So that's still a big move in the silver price from early in 2020 till now. Now we've had a correction, but with paper price smashes and the banks settling the fine out and the fake illusion that the market rigging for spoofing is over, it's not. I talk to traders every day who look at these charts, and I'm looking at the charts today myself, and I see the smashes in the charts. You can see them, and then the price starts recovering. But the increases by the U.S. Mint are way more than the spot silver price. The Mint released last week a statement on Facebook and Twitter about its new pricing strategy, saying in part, quote, in order for the U.S. Mint to cover rising costs, meet its fiduciary responsibility to operate at no net cost to taxpayers, and return money to the U.S. Treasury General Fund, resetting silver prices is necessary. The Mint's goal as a fiscally responsible, self-funded federal agency is to always provide the best quality numismatic and semi-numismatic products while maintaining their fair prices. The first objective is to ensure that the numismatic portfolio, all product lines together, be self-sufficient and cover all associated costs. The new silver prices reflect a sound business decision aimed at meeting these obligations. No tax dollars are used to fund numismatic operations. The United States Mint will continue to look for operations optimization and cost reduction efforts to deliver superior quality numismatic products at a fair price. And then it has a table of the price increases here. I have another article here from Clint Siegner, written on October 13th, director at Money Metals Exchange. The U.S. Mint is not raising prices on most silver eagles, but market forces may. So Money Metals Exchange has seen a large surge in demand for silver eagle coins in recent days. The word on the street is that a hefty $13 price increase was coming, and many people wanted to get their coins before prices rose. The news of a price increase isn't wrong. It's just that it won't directly impact anyone except those people buying high-priced coins in specialty packaging directly from the U.S. Mint. The Mint is not currently raising prices on the bullion strike version sold to wholesalers. The uncirculated silver eagles that bullion investors buy by the millions are not included among the coins subject to the current round of price increases. Rather, it is the price for this item, and he has like an image above in the article there that is going from $54 to $67. Almost nobody but amateur coin collectors and gift givers are or should be buying this particular item. Money Metals already offers the same coin minus the fancy packaging and the W Mint mark for about $25 less than the current U.S. Mint direct price. Regular uncirculated eagles will be an even bigger bargain after the price increase goes through. So-called modern rarities, like the ones the U.S. Mint sells online, are rarely a good bet as an investment. If you were to try to sell such an item, dealers will not pay anywhere near the sort of premium that unsuspecting buyers pay the U.S. Mint when the coins are first purchased. The Mint makes too many of these types of silver coins for them to be truly rare, so they're not really numismatic coins. Investors said they're just sold as numismatic. They're not really numismatic because they're not rare enough. Investors should buy regular silver eagles, and premiums today are lower than a month ago. The timing may also be good because the U.S. Mint will stop production of the 2020 date on U.S. Silver Eagles Day coin soon and begin the changeover in their retooling for production for the 2021 American Silver Eagle Day coins. Supplies of the Silver Eagle can get scarce in December and early January. It also looks like a good time to be buying silver in general. Demand for silver coins, rounds, and bars has risen dramatically this year, and it may go even higher in the years to come. Election uncertainty, economic fallout related to the global pandemic, and massive money printing and borrowing create a perfect storm driven safe haven buyers into physical gold and silver. And again, this article was written by Clint Siegner, director at Money Metals Exchange. Now, I have some very brief opinions on numismatics. I am by no means a numismatic coin expert. I do not collect numismatic coins. I've gotten a couple as gifts. But a lot of my friends have been suckered on trying to buy from unscrupulous bullion dealers over the years with bait and switch tactics, where a discounted coin sale, like on a discounted silver or others, and then they get on the phone with the bullion dealer and they're sold marked up high numismatic coins at big premiums. So you have to be careful of that, which bullion dealer you buy from. I have a number of friends who are numismatic coin collectors, and normally the amount of customers who purchase numismatic coins is a lot smaller. It is a lot smaller market. So maybe the people in this environment who are already affluent, who have benefited maybe from the asset price inflation, the Cantillon effect, for a long time now, they might be looking to purchase numismatic coins in this environment because maybe they have quite a bit of discretionary income. They want to sell some real estate stocks or bonds before taxes, capital gains taxes or dividends taxes or some of these other taxes that might be layered on in the years to come go up on them. So the demand for a lot of these numismatics is nowhere near as high. The amount of customers available to purchase them. Now we're seeing stories, and I've covered this in recent shows over the last couple weeks, about artwork, Pokemon cards, comic books, high-end baseball cards like signed rookie cards, other collector memorabilia. The majority of Americans, Joe and Jane, don't have the extra discretionary income to afford all this. Now, maybe for certain smaller premium stuff like comic books or some Pokemon cards, maybe some lower value first edition Pokemon cards, obviously not a Charizard one, they may be able to afford stuff like this, but it's normally a lot smaller, more high-end collector, so it's a lot less potential customers to sell this to. So I'm not a big fan of numismatics. Now, I know some people love them. They look great. They're rare. If you're buying them for the beauty, like a piece of artwork, then okay. If you're buying them because you plan on there being a lot of customers being able to purchase them in the future, I would not necessarily count on that. The other thing that a lot of numismatic people say is that FDR, when he confiscated or attempted to confiscate gold in 1934, is that numismatic coins were not confiscated, but the environment nowadays might be different because the government already has taxes in place for high taxes on physical gold and silver ownership. You don't get to lock in the long-term capital gains taxes. I think the taxes for gold and silver are taxed as a collectible at like 28%, which is still a lot higher than long-term capital gains taxes for buying and holding a stock. Although if Joe Biden does win the election, who knows what's going to happen to long-term capital gains taxes for stocks, bonds, real estate, and dividends taxes and those things. The assets are going to be taxed a lot higher. So a lot of the selling points that a lot of these salespeople have said for numismatics, that in the past time that silver was never confiscated. The U.S. government FDR actually stockpiled massive amounts of silver and actually created hyperinflation in China because they were on a silver standard, and all the silver, an enormous amount of silver in China, FDR was paying such high a price, the U.S. Treasury was paying such high a price, the U.S. government was paying such high a price for silver relative to the market price that a ton of physical silver from China and all over the world came here to the U.S., and the U.S. had well over 1 billion ounces of silver stockpiled in the mid to late 1930s. And it destabilized a lot of other governments that were on metal standards. But the selling points for a lot of these numismatic salespeople, you have to be very careful with them. So buying numismatics because you think that they're going to remain rarity, that there's going to be a lot more customers, I'm not so sure about that. It really depends if the economy improves. If the economy gets worse, there's going to be less people with discretionary income. Now, there will be some customers at the high end benefiting from the asset price inflation, close to the money trough. Well, close to the currency trough. It's not money anymore. It's just currency and credit floating around. It's creditism. It's Cantillon effect and creditism. Okay, that's my little rant. That's my little analysis there on numismatics. I'm by no means a numismatic expert, but I do have friends who collect numismatics. A lot of them are very affluent, so they collect them for beauty. They don't really collect them for price. And then I have a lot of friends who have been ripped off by bullion dealers doing bait and switch on numismatics. Okay, so these articles will be below the video in the information and description section. Fred Hickey has some really good tweets out about the gold market. From a contrarian standpoint, the apathy for precious, he's a gold stock newsletter writer, also technology stock, the high-tech strategist, but he covers gold stocks too. He is at HTSF Hickey on Twitter. From a contrarian standpoint, the apathy for precious metals Miners bodes well for the going into the earnings reports. Silver's up 40% year over year. S&P 500 earnings for Q3 expected to be down minus 19% year over year. Many miners will report 100% year over year earnings per share gains. And then the amazing amount of apathy regarding gold silver miners, lack of discussion, extremely low trading volumes, just 1.5 weeks away from what should be stellar earnings reports, with gold up $400 year over year and up $200 in the third quarter versus the second quarter. Total reversal from widespread excitement 3 months ago. And this is when this pullback in the gold price is when value investors like Warren Buffett, this is why he bought a little bit, in my opinion, of Barrick Gold. And he's probably, you're going to be seeing this in the next 3 to 4 months. You're going to see that Warren Buffett and the other value investors that will be copying him, maybe Mario Gabelli and some others, will start to accumulate the better gold stocks. So I think in the next 3 to 4 months, you're going to see in the 13F filings that Warren Buffett of Berkshire Hathaway and other value-oriented investors were massively accumulating the best gold stocks, because their balance sheets are really good, their profit margins are excellent, their free cash flows are very robust, and dividends are being hiked. How many other industries do we have that, where the net debt, the amount of net debt on the balance sheet is down enormously? But because gold stocks are not going up every day, the excitement's down a little bit. But for a value investor, for a contrarian, this is a good time to accumulate more. Super chat, $5 from JB Weld. Thank you for the $5 super chat. He is also a Patreon account contributor, one of over 1,000. So thank you for sticking with me. I appreciate it. The DNC is a SPAC. No comment. That is a good laugh, though. Thank you for the $5 super chat. Super chat from Leon V, $4.99. Thank you for the super chat. What are the advantages and disadvantages of the SIVR and SIL in silver ETF? SIVR? I haven't looked at that in a while. Let me look. I am not familiar with the SIVR. I imagine it's going to be very similar to the SLV. The only physical silver trusts I like are Sprott ones, because you can redeem those, and they have independent verification of the metals in the vaults. They have independent audits, and you can see copies of the audits. You can see a list of the bars. The only ones I trust are the different Sprott ones. The Sprott Physical Gold Trust, Sprott Physical Silver Trust, Sprott Central Fund, which is a mix of gold and silver. They have a Sprott Platinum and Palladium one now. Those are the only ones I trust. And with the Sprott ones, you can actually buy and hold them and lock in a long-term capital gains tax. Thank you for the $5 super chat. And Amalia Nicole Chrysalis Nix. Buying numismatic coins close to the cost of gold. How many numismatic coins are going to sell for spot price, though? Normally there's a big markup. Unless you're buying numismatic coins that are a fraction, that are not an ounce of gold, that are like a quarter of an ounce of gold. Normally with numismatic coins, there's a big markup. You're paying a big premium. If you can find numismatic coins at a discount, good luck. You might be able to do that at like some yard sales, at a garage sale, yard sale. I have friends who go on the week, well, before the pandemic, I don't know about now. Before the pandemic, I have friends who are going to like those locker sales, you know, where people forgot to pay their bills for renting storage lockers, and they were picking up cheap gold and silver. They were picking up antique silver. They were picking up silver coins and bars. They were picking up some numismatic coins. They were going to yard sales, garage sales, estate sales. You know, where people advertise, like they make flyers and then they staple it on trees, or they tape it onto like an electrical post, that there's gonna like a cheap estate sale. You can pick them up there. That's like the only area where you're probably gonna get numismatic coins at a discount, because the people selling the metal, A lot of times those people selling the metal don't even know the spot price. So that's the only time you're going to be able... Less confiscation risk? I don't know about that. I don't know if there's less confiscation risk for numismatics. The main mistake people make with numismatics is they get suckered, bait and switch. So they listen to like a YouTube video about gold and silver, and then they pick out the wrong bullion dealer, and then they get suckered with bait and switch on numismatic coins. Oh, this is an excellent super chat question here from JB Weld. Thank you for the additional $20 super chat question. Won't any dividend taxes or capital gains tax increases drastically lower equity valuations? In theory, they should. However, in this dystopian new normal, I'm not so sure anymore. Because there's going to be so much currency and credit sloshing around. Look, the Fed's balance sheet, with all the stuff the Fed's going to have to buy, but the corporate bond bubble was enormous before the pandemic. There was questionable cash flows just to service over 10 trillion in the quote investment grade corporate bond bubbles before the pandemic. After the pandemic, cash flows are not back. Look at Disney. I mean, Disney's one of the worst examples because Disney has so much on movie theaters and theme parks, tourism stuff, travel tourism. Disney's gotten absolutely hammered. And Disney's investing in Disney Plus. And maybe over the next 4 or 5 years, Disney Plus will be profitable, but their profit margins, as I highlighted in a recent article, are going to be a lot smaller on Disney Plus than they were charging thousands of dollars to families to go to their theme parks for long family vacations and for cruise ships. So their margins are going to be totally shot. So in theory, yes, you should be right. Raising taxes should hurt stock valuations, but in this new normal, if they're going to put enough currency and credit into the system, if the Fed's balance sheet goes over 10 trillion, if the Fed buys tons and tons of these no longer investment grade but faked investment grade corporate bonds and junk bonds and leverage loans and CLOs, collateralized loan obligations, all this other garbage, if the Fed buys this and the balance sheet is way over $10 trillion soon, maybe it's 20 trillion in the next 5 years. Who knows? Things are going to be pretty bad. If the cash flows are not back, the Fed, who's going to buy the bonds? Otherwise, it's going to be deflation. And the Fed allowed, without more manipulation and rules changes and bailouts, the Fed allowed deflation, and the other central banks and Congress and the Treasury allowed deflation for all of 8 weeks. We had deflation, all right, for only 8 weeks. That was it. And the whole scheme, JB, and I've highlighted this with stagflate and tax and lie, the whole scheme, they have to have asset prices up, stocks, bonds, real estate up in nominal value. That's for all levels of government. George Gammon has done excellent videos on this. The state and local governments all need property tax revenues. The real estate values have to be up in nominal value. Even if you don't invest $1 in your house and the property value goes up enormously, the values, I'm starting to lose my memory here because we're way over 30 minutes. So the value, the nominal value has to be for stocks, bonds, real estate, it cannot stay low because the federal government is so reliant on capital gains taxes for stocks, bonds, real estate, and the state and local governments are so reliant on property taxes for real estate for higher nominal values. So yes, in theory, you should be right, but in this new normal, if they create trillions more in currency and credit for asset price inflation, for the Cantillon effect, they're going to try to force asset prices higher in nominal value. The end game is more stagflate, tax lie. And that's the best case scenario. There's much worse case scenarios than that, which I've talked about at length over the years. I don't want to think about those too much, but I expect and prepare for the worst, and I hope for the best. And I think that's the smartest preparation that we can do. Okay, well, we're almost at 40 minutes here. This is way much longer than I wanted to do for a live stream show. So thank you, everyone, for listening. Hope you all learned a lot. If you are new to the gold and silver markets, take a look at Gibson's paradox that Lawrence Summers wrote about. He distinctly said, Larry Summers, who a lot of there's tons of these like so-called political hack journalists in the financial mainstream financial media kissing his butt on Twitter and elsewhere. Wrote about manipulating the gold price when governments manipulate interest rates lower and the balance sheet of the central bank expands. So they've been talking, this is something that the gold community, longtime people in the gold community like myself, Dave Kranzler, the Gold Antitrust Action Committee have been talking about for a long time. That it was right there. They told us in the research papers they were going to manipulate gold and silver prices. And yet, a lot of people were calling that conspiracy theory. And here we are, the banks settled fines for admitting some type of market manipulation, although that's just the tip of the iceberg. There's way more than that for admitting spoofing. They paid almost $1 billion fine, JP Morgan. So that's the new normal. More stagflate tax lie, more asset price inflation with the Cantillon effect and currency and credit sloshing around that the deflationistas will say is not inflation at all.